Hi, welcome to our Employee Retention Tax Credit webinar brought to you by HD Davis CPAs. My name is Lucy Mendez. I'm a financial research specialist.
My name is Alex Bohr. I'm an accountant at HD Davis, and I also specialize in payroll.
Let's get started. Here's our agenda for today. We're going to talk about these topics. What is the ERTC? Who is eligible for this credit? Other things to know and keep in mind, how to calculate the credit, and how to get prepared to go talk to your professional accountant or CPA. Just a small disclaimer, this information is current as of August 15th, 2021. It's best if you do talk to a professional about how to best position your business to benefit from this credit. So what is the ERTC? So this is an incentive intended to encourage employers to keep employees on payroll while they were navigating the effects of COVID-19 pandemic. So eligible employers can get a payroll tax credit equal to a certain percentage of eligible wages that they pay to their employees. Now the ERTC was allotted $80 billion. And many businesses are not even considering this credit. It might be because previously, if you had applied for PPP, you weren't eligible for ERTC, but that has changed now. So there's a lot of money being left on the table. So just as a visual, if you were to place $80 billion, bills end to end, you would go to the moon, go around the moon 9 times and come back to Earth. So that's a lot of money. And the point is just to get you to consider taking a look if you qualify for this credit. And also, if you think you do, definitely talk to a professional about it. So who is eligible? There's 2 ways to be eligible. One is the gross receipts test, and the second way is through governmental orders. So in 2020, if you had a reduction, a 50% or more reduction in your gross receipts, you are eligible. In 2021, you only need a 20% reduction in your gross receipts to be eligible. And this would be quarter per quarter. Or you could have had government mandated partial or full shutdowns that affected your business, and that would make you eligible. Another thing to consider would be the size of your business. So you could either be a small or large business, and the way they calculate it is through full-time employees. So in 2020, a small business was 99 or less employees. A large business was 100 or more employees. In 2021, that changed. Now it's 499 employees or less to be a small business, and 500 or more to be considered a large business. And the business size matters because if you're a small business, all your wages qualify that you've paid. And if you're a large business, only the wages paid to those who could not work during the government order will qualify.
All right, to build on who is eligible for the employee retention credit, we wanted to focus on 2 industries specifically, was restaurants and then churches and nonprofits. And the reason that we wanted to just give a little bit of focus to these is because they're groups that we've seen a lot of them be able to take great advantage of the employee retention credit based on government orders last year, or reductions of gross receipts. So restaurants is one of the most clearly affected industries when it came to government orders last year. We're right on the border of PA and Ohio. We had a lot of our restaurants were completely closed for so many days, and they were restricted to a limited capacity for several months, all the way up through the end of May 2021. Some of the other rules for restaurants that are important when considering ERTC is that you can't use wages that are paid for the Restaurant Revitalization Fund grant for ERTC. And you also cannot double dip the wages used for Triple P forgiveness for ERTC, which that applies for anybody who's doing both Triple P and ERTC. And then another thing is that tipped wages are eligible for ERTC. That is something that was just recently clarified last week by the Department of Treasury, and they gave some new guidance on the employee retention credit. Tipped wages used for ERTC can still be used for the tip tax credit. I know when we were kind of talking it over, discussing what was going to happen with all that, we were wondering if the tip credit would be affected. They are giving you the ability to double dip, is what you'll hear it called, and take the credit on those wages again. So you're going to be able to take that credits on those wages multiple times. So this is a huge deal for restaurants and something I should be aware of. When it comes to churches and nonprofits, it becomes a little bit different. With churches, there's usually a religious exemption for most of the government orders that were placed out in the United States last year due to COVID. As a violation of free speech, you can't stop the church gathering. But what ends up happening is there are other ways that these orders end up affecting them. So some of the ideas that I've seen is a lot of churches have a daycare program where they'll be taking care of kids at the church. So if the daycare for the church was subject to government restrictions, whether it's limited capacity or if they had to completely shut down, then they would be able to claim credit on any wages paid during that time period. Another thing to consider with nonprofits and churches is fundraisers. So the mass gathering orders prevented people from gathering for religious reasons, but if you're gathering for a fundraiser to raise money for your nonprofit or for a cause, when you're raising those funds at an event that you normally hold, and then you could not hold last year because of the COVID restrictions, in our opinion, that's looking like you should be able to use a government order in order to claim yourself eligible for the ERTC. And basically, when it comes down to wages with nonprofits and churches, it can get a little bit weird because they're sometimes taxed a little bit differently. But ultimately, wages that FICA taxes are paid on is typically the wages that would be considered eligible for the ERTC. And then the next thing with the who is eligible is I wanted to just give a little bit of background on the gross receipts test. So the gross receipts test is basically to see if you had a significant enough reduction of income for the test quarter compared to the same quarter of 2019 to deem them eligible to claim the employee retention credit for that quarter. So in example one, we have we're considering 200,000 as our 2019 quarter, and then 180,000 test quarter. So it's 2020 and 2021. So that's a 10% drop in gross receipts. So that would not qualify based on gross receipts for either 2020 or 2021 because it does not meet the minimum reduction requirement for that. Example two, you'll see that there's a 60% reduction of gross receipts, and that would qualify them for 2020 because the reduction is greater than 50%. And it would also qualify them for 2021 because it's greater than 20% reduction. And then example three, very similar. It's over 50%. It's going to qualify for both 2020 and 2021. And then example four is one where you have a reduction of 24% of gross receipts. In 2020, that would not be enough to be eligible because the mark was so high, you had to be at 50,000. But in 2021, that makes you eligible. So in 2021, you can see you're going to be eligible more often, and 20% reduction of gross receipts is really not that crazy. More people are obtaining it than they would realize. So you just want to have good record keeping so you can determine that. And then just to touch on the basic definition of what is gross receipts, it's basically all of the gross income. So that's all of the dollars that are all the sales that you have for your business, your investment income, rent and royalty income, and then for nonprofits, donation and grant income as well. So all of that is getting factored in, and that's what you can be using. And then if you go to the IRS website, there is a more specific definition, but for 95% of businesses out there, that definition will apply for what is gross receipts. Other information to know is just we wanted to kind of touch base on the government orders a little bit. So government orders, they have to be actual government orders coming from an official. So whether it's the mayor of a city, sending out orders telling people they need to stay inside or all restaurants need to close, or if it's the governor of the state, or if it's the Department of Health for your state, that's where most of the orders are taking place. So it comes down very much state to state. And it is important to keep in mind that when it comes to government orders, it doesn't have to just shut down your business. It could just prevent you from being able to operate. So not everybody is a restaurant or a retail store, but they might have something where their supplier was completely shut down for them, or because they had a government order that shut down one of their suppliers, and that completely put a halt to their business, we could use that argument to say, yes, a government order had me shut down because of what took place. So it is some interpretation that goes into that, and there is a little bit more flexibility with some of it than others, but you want to make sure you're taking that stuff into consideration. So going through your state's timelines of government orders definitely helps. I've gone through them for Ohio, the Department of Health has issued orders throughout 2020, and then when did they start releasing them in 2021? So restaurants is an example of, they basically had all of those orders for limited capacity were in place up until June 1st. So that was a long time that there is eligibility for everybody who runs a restaurant. So that's just what I wanted to touch on there.
Okay, so this is an important definition. What is an eligible wage? Eligible wages are employee wages, health insurance costs, tips, and commissions. There are some wages that are ineligible, such as wages claimed as PPP forgiveness, wages used for the work opportunity tax credit, wages used for the restaurant revitalization fund or grant, owner wages if they own more than 50% of the business, and wages of related individuals that are related to the owners that own more than 50%. And we'll give an example. So who is considered a related individual? Basically anyone in your family, a child, a grandchild, brother, sister, stepbrother, stepsister, father, mother, grandparent, stepfather, stepmother, nieces, nephews, aunts, uncles, son-in-laws, daughters-in-law, sister-in-law, brother-in-law, mother-in-law, father-in-law. So anyone related to you would be considered a related individual. So here's an example of how ownership and related individuals affects your eligibility for the ERTC. So here the related individuals are shown in green. So together they own 51% of the business. So because it's more than 50%, their wages are not eligible for ERTC. Now, if they also have other relatives working in the business, such as son or niece, their wages are also not eligible. Now, the 49% owner in blue, his wages are eligible for ERTC. Now, how do you calculate credit? So there's differences in 2020 and 2021. In 2020 and in 2021, there's a limit of $10,000 eligible wages per employee, but in 2020, that limit is per year. And in 2021, the limit is per quarter. So much more money in 2021. In 2020, you can take a max credit of 50% of the eligible wages, which would come out to $5,000 per employee. And this would be the entire year. Now in 2020, there's a max credit of 70% of wages, which is about the maximum of $7,000 per employee, but this is per quarter. So for the entire year, the max per employee would be $28,000. And
all right, I'm going to go through a quick example of how the calculation for the employee retention credit can go. And we're doing an example with just some real small businesses. They got 3 employees with reasonable salaries, but we want to show you guys what that credit can add up to in each round of the ERTC. For 2020, we have 3 employees here that are paid varying amounts, but 2 of them are over 10,000. One of them's underneath at 9,000 for a total of $36,000 of wages. And then if you look down, the next row is eligible wages. Again, it's limited to 10,000. And then this is going to be the amounts that's actually going to use to calculate the credit. So if you remember in 2020, the credit is 50% of the eligible wages. So they're going to get a credit for $14,500 for 2020. So the only other room where that they could take any extra credit if there's any other wages in 2020 were to be if that middle person were to get paid $1,000 more, they would get 500 extra. But outside of that, he's capped out for the entire year of 2020. And then when we look at 2021, we have the same example going, 36K of wages to these employees for the quarter. And then we have The eligible wages is the same. It's the 29,000, except for in 2021, there's a 70% calculation for this credit. So that totals up to $20,300 for the credit for that quarter. So almost $6,000 more, or $600 more, or no, yeah, $6,000 more of the credit for this quarter. And then that's just there, that one alone. And then again, the big thing with 2021 is that you are not limited to a wage base for the entire year. That resets for the next quarter. So if they ended up being eligible for all 4 quarters of 2021, they could potentially pick up $81,200 of credit, which is an insane amount of money for an employer that only has 3 employees. So we did this example to try to show how quickly this credit can add up and how significant these amounts of money can be. Lisa and I were discussing some of the clients we've done this for earlier, and some of them have gotten in single quarters $150,000, $190,000, and like they're not that large of employers; they're just regular small businesses. But they had been hit either by government orders or had the gross receipts reduction and the right timing to be able to claim this credit, and it's going to end up being a nice check that they get into their bank to help out continue operating through these tough times. So this credit does add up really quick, even if you only have a couple of employees. So it's just, again, trying to emphasize that this is something worth looking into and talking to your accounting and tax professionals about. The next thing I wanted to touch on was how to claim the employee retention credit. So it is a payroll tax credit. So we will be claiming it on the Form 941, which is your quarterly federal tax return for payroll. Whoever your payroll provider is, they're the ones who are preparing these forms for you, whether it's White Glove, ADP, Paychex, Heartland, or whoever else, or if you've been doing it internally, your internal bookkeeper is preparing these forms. These forms have lines for the employee retention tax credit. So if you plug in the eligible wages after you've determined who's eligible, excluded all the related owners, everything like that, you've determined those wages weren't being used for Triple P or the Restaurant Revitalization Fund grant, you can now go and look at it and say, here's my eligible wages. You plug that into the return, and then that has a couple lines to multiply it out. So you filed on there, and then if you can file it on your originally filed return for 941, you are likely to get your money in 6 to 8 weeks, which is a much quicker turnaround than if you have to be filing the 941X, which is the amended 941 return. And that's just a slower process because it's going to a different department of the IRS, and everything has to be done by paper, and it's just much slower. So the claiming the credit on the 941X, that's when we're claiming it retroactively, which, they changed the rules in December saying you can do Triple P and ERC. So originally, nobody even thought they could do both. So of course, they're going to have to go back and amend. We don't have a time machine to go back and start filing returns, and the IRS didn't even have, the proper tax forms in place at that time. So, when we look at this, it makes sense that we're going to have to file a bunch of these 941X. And part of the reasons of doing this is also we have to get our Triple P taken care of and knowing what our wages are. So that way we can try to optimize the two of them together, because you want to make sure you're not double dipping on Triple P and the ERTC. And then the last thing to know is that with all of these delays, due to the 941X being filed late and then the IRS being behind, the timeline for people to get refunds after filing a 941X is looking to be somewhere between 10 months to a year. And that was what they had said a couple months ago. So I don't know if the IRS is more behind now, but it's something that it is a significant amount of money, but you have to be patient because it's going to take some time to get to you. But if you think you might be eligible for the quarters coming up, that is when you want to be on top of it, because you can try to get the credit claimed on your current files, Form 941 for quarters 3 and 4, 2021. So we also just wanted to kind of give you guys a list of things to have ready or try to get prepared if you were to go to talk to your accounting or tax professional. This is the stuff that if you think you might be eligible and you could provide this to them, it's going to allow them to do the best job they can to get the most out of this credit. So one is a government order that you think applies to you. If you're not just going to be eligible based on gross receipts test and you're saying a government order applied to you, having that government order ready to hand to your tax professional and say, hey, here's what I was shut down for. That'll give them the ability to do, like, to figure out that timeline a lot better and to talk to you about how it truly affected your business, because some of it is, there's a little bit of semantics involved of us of us saying, did this truly affect them? Was their business partially suspended based on this order? And a lot of them it applies. There's people cannot conduct business in the way that they normally do. So just try to do your research, try to help out with that the best you can. We had one client who brought it to me, already highlighted and circled, and he said here and here, and it was just perfect. It was so much easier than going and doing research like I had for a bunch of other clients. Quarterly financial statements is another huge one because of the gross receipts test. I mean, we kind of went through an example earlier. The gross receipts test is the easiest way to qualify. It's numbers don't lie. So you put them in there. If you hit that 50% mark last year or the 20% mark in 2021, you're going to have eligibility and you're going to be able to claim the employment retention credit. So having that information ready to go will make it easier to do that. So if you can get that information to your tax professional, that can definitely help them determine your eligibility outside of the government orders. Third part, obviously, with this credit being claimed on the 941 returns and using employee wages, you have to make sure you provide that information to your accounting and tax professional. So if you could get that all of your 941 returns for those quarters that you're looking to apply, so for all of 2020 and 2021, if you can get the employee wages for each quarter, and even better if you can get it into an Excel sheet or something so that they can really work with the numbers and try to get the best out of the credit. But you want to have all of those employees because they have to make sure they're limiting each employee to the $10,000 per quarter, or in 2020 per year, and then the employee count for each year. So what Lucy had discussed earlier with the large employer versus small employer, that significantly affects the ability for the business to claim the employment retention credit. So it is important to know how many employees you have. In 2020, the number was 100, so it was more difficult to be considered a small employer. So a lot of companies weren't able to take as much of advantage of it. But when they upped that to 500, that opened a door for a lot of small/medium businesses that can be taking this credit. So again, and that adds up to a very significant amount of money to those businesses that have a bunch of employees on top of having gross receipts or government order shutdown that applies to them. So something to definitely keep in mind. The step 4 we have on here is your triple P information. There's, with the not being able to use the same wages for triple P forgiveness as you can for employment retention credit, it's important to know how much you received for triple P, when you received it. If you have a copy of your forgiveness application, it's even better, because you do not want to be claiming employment retention credit in a way that contradicts your triple P forgiveness application, because then we will have gone and broken their rules, and we'll have to see what the punishment will be for that. But ultimately, is having that information is ready makes it easier for your accounting and tax professional to figure that out. So when I get somebody saying I got $100,000 on April 27th, 2020, I can look at their payroll reports. I wait till I see they hit that 100,000 of wages within the other forgiveness rules of triple P. I say, okay, I feel confident they hit their forgiveness here. We're going to claim ERTC for the time periods before and after that. So that's why that information is so relevant, because that allows your professional to be a lot more confident in going in and claiming this credit in different places. So that's another thing to have. And then your corporate tax returns, having those is important just so they can verify some information for the business. Having the right industry code might be important in looking at the government orders that apply to them. And also for 2020 is, if we're claiming this credit, there might need to be an amendment in place if your return is already filed, because you do need to adjust for the employment retention credits on the tax return. So that is something important to have. Is if it hasn't been filed, we'll typically tell you hold off on filing until we take this credit for you. The last thing is a list of individuals related to the owners. Some small businesses, there's a bunch of family working there. They got cousins, nieces, nephews. They got their sister, their brother-in-laws, and it's just a bunch of family. And, we having that list makes it a lot easier to say, okay, their wages can't count, their wages can't count, their wages can't count. So it is something important if you can get that information. Otherwise, they're going to get a call and then, another phone call and be guessing. And then if we find out later, we'll have to recompare. It's a lot easier if you can get that information to your tax professional right away, saying, hey, here's all the related people at my business. But outside of that, I think that covers most of what you'll need initially, and then just be ready to answer any other questions they may have for you as they try to calculate this credit for you. To the end of this, we wanted to show some of the changes that have taken place over the timeline of ERTC, also known as ERC. It was originally introduced in the CARES Act back in March 2020, the same one that Triple P was introduced with. And they had originally said, this is for the people who don't take Triple P, they can take the employee retention credit. So originally, we basically were telling all of our clients at H.E. Davis is, hey, Triple P is the way to go. Don't even worry about employee retention credit. We're not trying to mess with this. But they had those rules in place. The 50% eligible wages is good. And they up to $5,000 per credit per employee is the same. So, and same with the qualifier for a large employer versus small employer. Later on in December 2020, they did an overhaul a little bit. They revamped ERTC, and they said that you can take Triple P in ERC. And that was a big deal because obviously we had not taken advantage of it. And you guys saw previous to this how quickly these amounts can add up to a significant amount of money. So, now we're looking at it going, oh, wow, we could probably go claim it right before they got their Triple P and then for the time period after they got Triple P. So we definitely want to, that change definitely opened the door up a lot. And then they also went in and they added the 2021, the round 2 of ERC. And this one was even more significant because they took the limit from 10,000 per year and they said, no, let's make that 10,000 per quarter per employee. And let's make the credit not 50%, let's make it 70%. So like you're getting more opportunity to claim this credit and you're getting a more significant amount to claim. So up to $28,000 per employee. That's subject to change because we were hearing rumors that, Senate passed a bill where they would take away the fourth quarter eligibility. But again, that's part of the disclaimer here is that, this information has been changing from the time that it was drafted in March 2020. It was changed again in December 2020. It was changed again in March 2021. And then it was changed again last week. And then there's still more changes happening. But for the most part, they have a lot of guidance answered and everything's pretty set in stone. I think that the last thing that we're looking for is the possibility of them taking away a quarter of 2021 eligibility, but you would still be at $21,000 per employee. And then the other big change was the requirement to be considered a large employer is having more than 500 full-time employees, which opens the door up for a lot more businesses to take a huge advantage of this program. So that was another really nice change, and it allowed some of our clients to be able to, really reap some rewards from the employee retention credit. Yeah, so that's the change of the summary. That's a summary of the changes that have happened over the past year with this. And then other than that, we just wanted to say thank you for tuning in. And if you guys have any questions, you can reach out to our firm and we'll try to get everything answered. But get this information ready for your tax professional. Let them know that this is stuff that is scraping the surface of what ERTC is. And it's something that a lot of this information is still subject to change. There's some more complicated underlying parts that didn't seem like it'd be good to put into the webinar because it'd be a little confusing. But overall, we tried to give you the gist of it so that way you could say, hey, maybe I'm eligible. Maybe I should look into this, because that's really what we are trying to get people to realize to do. So thank you.